gold is following its historical pattern in a bull market, which means what? It means in this bull market, the peak will be somewhere close to $6,000 an ounce.
So switching gears a bit to financial markets, I've heard what you said recently about treasuries and the proposition they currently present, but can you give us an outline of your view of the comparative valuation of equities and bonds and your thoughts on treasuries from this point forward?
Well, you could look at the equity risk premium any number of ways. One of the ways you might want to look at it is the cyclically adjusted PE ratio, the inverse of that, which is the earnings yield, compared to the real, say, 10-year yield or the real long bond yield out of the TIPS market. And the relative valuations, stocks against bonds, is the most extreme it's been. It's at pretty well at the same level it was in the summer of 2007.
Mm-hmm.
And that was around the same time, if you remember, that Chuck Prince at Citi was telling everybody you got to keep dancing until the music stops.
Mm-hmm.
Well, the music always stops. And then the music always, comes back on the sound system. That's just the cycle of play. I like how bonds are priced right now. I think that it's just a waiting game. We've got obvious concerns over $9 trillion of Treasury refinancing. That is in the market. Everybody knows that number. But that's been a source of frustration. You've got the concerns over how much inflation is going to go up and for how long from the tariffs. And of course, all this plays into, the fact that, how much duration do you want to add when, cash is paying you well over 4% with no duration risk, no capital risk. So that's the one thing to keep in the back of your mind is that, and this is more for the stock market crowd, is that the one thing we can say with certainty is that Tina is no longer around,
mm-hmm.
right? There are alternatives. So alternatives, Ginnie Mae coupons, triple B corporates, or treasuries, or treasury bills. Like basically, when you go back to the last time the multiple was where it is today, the forward multiple now in the S&P 500 is 21. And that's where we were, for example, back in good part of 2020, 2021, we were at these multiple levels. But you see, back then, the risk-free rate was 1%. Today, it's closer to 4.5%. So that's very interesting that the stock market's telling you that it's going to price itself as though the risk-free rate is back near the floor. That's where the math just doesn't add up for me.
Mm-hmm.
So in terms of how I see the situation and understanding all the impediments, that are plaguing the bond market over the course of the past few months, that I like the math. I like the convexity.
Mm-hmm.
Okay. Like basically when we were at the lows in the 10-year treasury note yield back at the peak of the COVID recession,
mm-hmm.
It only took a 6 to 7 basis point increase in the yield to generate a negative return in your 10-year treasury portfolio. You had no coupon protection, almost zero. Today, we have, call it roughly 4.5% 10-year note. What would it take for you to lose money in the bond market? The yield would have to go up 70 basis points,
mm-hmm.
not 6 or 7, 70. Ergo, we would have to go back to the highs, not just to the highs. We'd have to go above the 5% cycle peak back in October 2023, when the Fed was still in its tightening cycle, and we had a completely different economy on our hands. Inflation is underlying inflation is lower today than it was then, and the unemployment rate is higher than it was then. So I like that math, that you have to go up 70 basis points to generate no return in your bond portfolio, because I really don't believe it would have to be one hell of a shock for yields to actually break above where they were in October 2023, when there was a ton of bad news being priced in to the Treasury market. Well, what if we look at the alternative? What if the 10-year note yield goes down 70 basis points? Is that outlandish? It takes us back to where we were last September. It doesn't take us back to where we were 5 or 10 years ago. It wasn't that long ago. Well, that would generate a total return of plus 10%. So up 70 beeps, 0, down 70 beeps, plus 10%. And so I like that range.
If you have questions about the current market environment and are looking for guidance on your portfolio, Wealthion can help connect you with a vetted advisor to get a free portfolio review. Just click on the link in the description below or head to wealthion.com/free. Outside of treasuries, I know you're recommending call it defensive bent as investors approach the next 6 to 18 months. Can you give us some other ideas on investments that you think make sense at this point in the cycle?
Yeah, I think that, within your... So I do like treasuries right now. I can't say I love them, but I like them. Within the stock market, I like what I refer to as bonds and drag. I like the sort of parts of the stock market that are correlated with declining bond yields. And I think the Fed will resume its rate cuts by September. I think we'll have enough clarity at that point. And the clarity will be that with the labor market loosening up, the inflation shock from tariffs are going to hit the wall in the labor market. And so what we'll end up with is a few months of higher inflation prints, but that'll trigger negative real wages, and that will trigger negative real consumer spending, which ends up bringing inflation right back down again. So the way you want to think about this is the price level will be higher, but inflation actually, because of the tariffs, counterintuitively, inflation will probably end up being lower because of the extraction of demand out of the consumer sector coming out of this. This isn't like it was, again, in 2022, 2023, we had a massive mismatch in a hot labor market where companies couldn't find the demand. Everybody was job hopping, and Uncle Sam was paying people not to work for extended periods of time. Remember, the jobless extension benefits were massive. Companies had to pay up. So we actually had a wage price spiral for a period of 18 months. It's not going to happen this time around. It's going to get snuffed out in the labor market. And that, again, came through loud and clear in the beige book. But I like, for example, I like utilities. I have for a long time. They've done great. Consumer staples. And I'd be saying, it could be the drugstores. It could be food producers, food retailers, tobacco. And I like the fat dividend yield and the dividend growth characteristics, though I guess a lot of people can't own them in their portfolio. But utilities, consumer staples, segments of healthcare. I want to be in areas of the market where there's stability, earning stability. I want things that typically don't hurt you in a recession, or can help you in a recession. There's one stock I can tell you that will never, the one stock historically that has never hurt you in a recession is Walmart. And I view that as a defensive retailer. So I would say that staples, utilities, healthcare, I want to be in low beta. I want to be very mindful of the beta, very mindful of the cyclicality in the portfolio. I want the dividend yield, and I want the dividend payout ratio in areas of the market that don't have a whole lot of correlation with GDP. On top of that, I've loved gold. I still love gold, the gold mining stocks as well, but physical gold. I would also say silver, playing some catch up, although it has more industrial characteristics. But I like the precious metals. I think the US dollar has entered into a bear market. I'm not saying that the US is going to lose its reserve currency status, but I do think that the US dollar has certainly been tarnished. I find it to be a really quite astounding comment that the stock market would be heading back to the highs, and yet the dollar has been sinking. I mean, to have an 8%, 9% decline in the dollar from the peak in such short order, that's like over a 20% drop in the stock market when you look at it from a relative risk standpoint. It's been breathtaking. So foreign investors are telling you something, and it's telling you that, because the truth is always in the price. The price of the dollar is telling you that something is being sold in the United States, and there is a reallocation to the rest of the world. So I mentioned utilities. I mentioned segments of healthcare, the more defensive areas of healthcare. I mentioned consumer staples. I like gold, as I said before, and the gold miners still trading at huge discounts. But I also want to have more international diversification. And I think that Europe looks very good to us. Europe has visibility. Europe has a central bank cutting rates. Their inflation rate is below 2%. The ECB is cutting rates. They'll continue to cut rates. And we don't have what's happening in the Senate right now. We don't have all the wrangling and the checks and balances. So it looks as though finally Europe's getting its act together in terms of their own fiscal bill, which is going to be significant for the next decade. Which brings me, by the way, to where they're weighing their expenditures towards aerospace defense. And that is a global theme. And you can buy the global ETF. It's not just the United States. Even the most pacifist countries in the world, like Japan, are increasing their military budgets. If you looked at the data that come out of the United States, you're looking at a bullish data point. Of course, spending on data centers is a massively bullish data point. The question is how much is already priced in. But in the defense sector, you look at the order books, you look at shipments and production. That is one part of the stock market I like a lot. I guess I wish I didn't like it because it reflects these ever-rising geopolitical tensions, but they're not going away. And the commitments to NATO expenditures is being taken very seriously by America's trading partners. So that's an area that has visibility. But this is what I'm saying. The idea generation really almost ends there. I would say, I mentioned Europe. I think that Asia is looking good to us. Asia, our scorecard for Asia in the past month has actually improved quite a bit, actually even more than in Europe. So I want that international diversification. You got better interest rates, better valuations, better currencies right now. And those markets are well worth a look. And that's, again, within an equity bucket that I would have, whatever your benchmark is, I would be below that benchmark. I want to focus. I want to hunker down right now and focus at this stage of the cycle on harvesting what you've already achieved in this, call it 5-year bull market. Got interrupted in 2022, got interrupted briefly in April. But I'd be using these rallies, these intermittent rallies, which are really headline rallies. I mean, almost all of the increase in the Dow off the April lows came on 4 days. Think about that. It came on reprieve day, and then we had the reprieve for China, then the reprieve for the EU, and then we had this, the appellate court, or the low, I should say the trade court. Now it's gone to the appellate court, but in any event, 4 days accounted for 100% of the increase in the Dow off the lows. That really tells you something. This is it's really a speculative sentiment headline driven market. So the answer is that I don't trust it. I actually would love to turn bullish again. And I was getting ready. I wrote a whole report right near the lows, which I sort of pulled back. Maybe I shouldn't have done that, but I'm not a day trader. But the market came back so fast. I just wrote it around what happens, when the VIX breaks 50, it's usually a buy signal.
Mm-hmm.
And it was a buy signal. But what's really incredible to me, Trey, is that, the trough multiple in the drawdown in April, the trough multiple was 18.
Mm-hmm.
18. And I have people talk to me how cheap the market, to 18. 18 multiple was the trough. 21 to 18, 18. I started in the business in 1987. And if you told anybody about an 18 multiple, they'd carry you out in a gurney on the way to the psychiatric ward. I mean, today, 18 is cheap.
Right.
Well, so that's that's narrative. But I'm really, broadly speaking, when again I come back to what Warren Buffett's been doing, building cash, what Powell told us about being in a dark room. What do? You stand still. You should be, and that means for an investor, if you're not more risk averse, you should be risk averse. If your portfolio today and your asset mix looks the same as it did 6 or 12 months ago, it shouldn't. So that means really culling the portfolio to your highest conviction and best ideas. And by the way, this is not a perma-bear talking, because at no point did I say you got to go out and load up on barbed wire, canned tuna, baked beans, and a sawed-off shotgun. I never once said that. You do want to have some cash on hand, though, because you're getting paid and it has optionality. But the major point is this: preservation of capital and the preservation of cash flow.
So you brought up gold, which is where we were going to end, and I appreciate your comments there in terms of gold and gold equities. But let's end with another bench clearing question. Do you think we're on the gold was up 27% last year, and we're up another 28% this year? I think you would agree that's sort of surprising strength. My question is, we know the three main fundamentals are anti-dollar sentiment, the U.S. deficit, Fed, cred, that type of stuff. But do you think we're on the cusp of a global monetary reset after all these years of studying the possibilities thereof?
It's quite possible. I mean, you keep hearing about the Mar-a-Lago Accord, and then the Section 899, that the U.S. would dare, as a retaliatory measure, impose a tax on interest and dividends on securities held outside the country. I've got to say this, that Liberation Day was a big day for me. I think Liberation Day liberated us from our sanity. When Donald Trump went in front of the cameras with all these reciprocal tariffs, and every country had a different number. It was like a bingo game. But there was a method to that madness, because those levies reflected two numbers. And that's why each country had a different number, because it reflected the ratio of the bilateral trade surplus that country X ran against the United States. That trade surplus divided by its exports, expressed as a percent, and then added on to the 10% baseline tariff. And so what was the message that the president was sending? Was that he wants the bilateral trade surpluses that countries have with the United States to vanish completely. Even though it's completely appropriate and normal, and I would say desirable, for the world's reserve currency to be the country that runs trade deficits with the rest of the world. Because being the world's reserve currency means that you attract all this capital inflow. That capital inflow generates wealth, generates spending that gets spent in imports. No other country in the world has such a low savings rate as the United States. No country in the world has a consumption to GDP ratio of almost 70%. And so what happens is that the capital account and the current account have to balance. It's called the balance of payments. So if Donald Trump wants to shrink the trade surplus, trade deficit that the U.S. has and get it to zero, what happens to the capital account?
Mm-hmm.
And what is the message on Liberation Day? The message beneath the message, and I wrote about this, is that what is he signaling? You got to think that this is somebody who's been talking about unfair trade and tariffs since 1987. And now he can do something about it. I think the message was that the burden on the middle class and middle America of being the world's reserve currency is just too much.
Mm-hmm.
That's the first time that I wrote a report saying that for the first time I'm writing this, that perhaps in my life we will see the end of the US dollar being the reserve currency. We just don't know what's going to pick it up.
Mm-hmm.
But remember, it could well end up being the euro.
Mm-hmm.
It could end up being the euro. The euro was supposed to be the challenger in 1999, if you remember, on its introduction. But it's hard to make book right now. But I would say that, when you're taking a look at things like CDS spreads, and you're taking a look at, what that hidden message was. That hidden message was that we don't want to run trade deficits anymore. Even though it's completely normal for the United States to be running trade deficits, there's nothing wrong with it. It's actually the role of the reserve currency.
Mm-hmm.
Understanding that the balance of payments have to balance. And the message, like I said, is that maybe the world's reserve currency is just too much to bear. And look, this is, I think that Donald Trump will continue to push the envelope. You're asking me, is he moving to reset and reshape balance of trade? 100%. And the last president to have done it on this scale was Richard Nixon.
Mm-hmm.
Correct? Richard Nixon.
Mm-hmm.
And so going off the gold standard. So this is going to be, so I think that we are in the early stages of heightened state of uncertainty, confusion, and chaos. It's not going to go away anytime soon. As far as Donald Trump's concerned, this is all going to be for the greater good. For that we'll see. But, as far as gold is concerned, look, gold, how do you value gold?
That was going to be another.
They value the crypto people value Bitcoin
mm-hmm.
on the relative value trade on gold.
Mm-hmm.
They call it digital gold. I say, okay, well, I'll just buy the real thing because the beauty about gold is that it doesn't have correlations with so many other things. It's such a great non-correlated asset to have in your portfolio. Bitcoin is most correlated with the NASDAQ 100. I don't want to buy gold if it's correlated with the NASDAQ 100. In fact, it's inversely correlated with the risk on trade. That's why you want it in there. It's a ballast in the portfolio. But how do you value gold? How do you do it? You can't do a dividend discount model on it. You can't do, real interest rates, inflation expectations, default risk, recovery rates, term premium. How do you value gold? Gold is basically 1 divided by U, where U is uncertainty.
Mm-hmm.
Or I should say 1 divided by C, where C is certainty. Mm-hmm. That's the quotient. It's perfectly proportional to uncertainty. And on top of that, I started turning bullish on gold back in 1999. When I was just making that transition from the Bank of Montreal to Merrill, when that when the central banks starting in Europe announced that moratorium on their gold sale program that had undermined gold for so many years. So let's not forget, especially those people that watch QE, let's not forget the power of the central banks. And we're talking about all of the central banks globally, not just the BRICS, not just China. There are no central banks globally selling gold. 3/4 of them are buying gold every single month. Mm-hmm. They are diversifying. That might help explain the downdraft in the US dollar and the strength in gold. And you don't want to bet against central banks. They have deep pockets, but there definitely is a reallocation and a diversification among central banks back into gold. And I imagine that the day that I hear an end to that program, I'll reconsider the gold. We did all sorts of work on this, all sorts of work on gold. And I would tend to agree with you, up almost 30% 2 years in a row. Okay. I think we should expect a pause. That would make sense. Of course, gold's benefiting as well from this downdraft in the US dollar, but be that as it may, the work that we've done, and we published it, and this is probably within the next 5 years, we believe, because gold is following its historical pattern in a bull market, which means what? It means in this bull market, the peak will be somewhere close to $6,000 an ounce. So I am not trading around it. I am buy and hold. And if there's dips, I call my dealer and I buy more gold bullion, or actually what I prefer now are gold coins, because they're prettier. But that is actually gold remains probably, undeniably my highest conviction trade.
Excellent. So, by the way, I tell people that coins are a great place to start as well, because they're portable, they're recognizable. You can get access to them, move them around. So, there's a hell of a lot of utility in gold coins. So, Dave, thanks for your time. How can viewers learn more about Rosenberg research and take a spin in what you do?
Great. Well, I produce probably 12 different products. We span all the asset classes. We span all the sectors of the stock market. We cover the entire fixed income market, currencies, commodities. And we have clients in 40 countries. 70% of them are in the States, and half are individual investors and half are institutions. So we basically, and whether you're a retail person or you're a CIO, the questions are always the same, in terms of the economy and the markets. I actually have a 24/7 hotline for people who want to access our information line. Clients can do that. I spend 20% of my day just answering back client emails, because the one thing we can control is client service. Can't control the markets, client service you can't control. So I would say that a couple of things. The first is, if you just Google Rosenberg Research, it'll take you onto the website. Feel free to surf it. There's samples on there, and you can also log in for a trial, which I'll get into in a second. You can just go to information@rosenbergresearch.com. That'll take you into the portal. You can actually end up speaking with one of my client service professionals, and we can get you signed on to a 1-month free trial. In fact, that's what I'm going to say, is that everybody on the call will have access to a 1-month free trial if you so desire. And you can kick my tires and find out for yourself that while I'm cautious and conservative and focused on capital preservation, I ain't no perma bear. If you want to reach me personally, okay, I'm not going to give up my phone number. Okay, that's maybe a little too personal, but people want to reach me directly. Here it is. drosenberg@rosenbergresearch.com. All one word. drosenberg@rosenbergresearch.com. And I'd love to hear from you.
Perfect. Dave, thanks for your time. And I'm excited about all of the ideas that I think we share about what's going on in the markets over the next 6 to 12 months. And we look forward to getting back in touch with you in a few months to see how you're doing.
Great. Well, thanks. Thanks very much. Fasten your seatbelts.
Thank you, sir. We have the opportunity now to visit with Jonathan Wellum of Rocklinc Investment Advisors, who happened to be tuning in on my conversation with Dave Rosenberg to collect some of his thoughts about what Dave had to say. So, Jonathan, what do you think? Does David have a good view of the world? Do we agree?
Yeah, it's always a privilege to sit in and listen to David. He's very, very insightful and bright in terms of his economic analysis. And as he pointed out, you're not always correct because factors can impact your decision making. But I've been following David since he was started really at Merrill Lynch and then Gluskin Sheff and so forth. So I really appreciate it. A couple of observations. First of all, it was good to hear him just defend his recession call of a couple of years ago and why that really didn't come to fruition. I think he has a very powerful rationale for why the recession call didn't come to fruition, simply because of all of the Biden spending and the green agenda and so forth. The fiscal the fiscal stimulus was so large that it overwhelmed the Federal Reserve's increase in interest rates. And because I think most of us thought if you're going to increase interest rates that much, you're going to have to end up with some kind of recession. And we didn't. But what I like in particular about David is he hasn't backed off. He continues to look at the facts, and he holds his ground. And he's not going to be scared to continue to say, listen, things are getting tough out there. There are factors that are certainly looking towards a recession. In fact, he argued very strongly, I think, for a very weak economy, a much weaker economy than a lot of people are looking at. And I think he drew that position basically by looking at the Fed Beige Book, which I think is a very powerful place to go if you're going to actually look at the stats. And so he rattled off so many different stats that show that, the underlying economy is not all that strong. It's not a broad and deep, strong economy here. There's certain sectors that are doing well that have been pushed up by, the data centers and AI and some of the technology areas. But in fact, he said about 75% of the U.S. economy now is stagnating or contracting, which is a big number, up from just 50% about 2 months ago. And so I think he's really, onto something there. The family, starts in terms of home starts and construction starts and retail and auto and all of these things are under a lot of pressure. And so I think, again, he really appealed to a lot of facts that show that investors should be careful. Again, it doesn't mean there isn't opportunities in the marketplace, but with all of the uncertainty, as he emphasized a number of times, because of tariffs and the changing trade patterns around the world and some of the things that clearly that Donald Trump is pushing the Trump administration, this is all leading to, again, uncertainty in the marketplace, uncertainty in terms of businesses. And he rightly noted that savings rates are now actually coming up a little bit. So people are being cautious. Consumer spending is slowing. And, the affordability of homes and so forth continues to be weak and so on. So I think, again, all of those things point, as far as I'm concerned as an investor, be careful about what we're buying. Make sure you're buying things with good valuations, keeping a little bit of powder dry and so on. I think these are all very compelling reasons. And just because the recession hasn't come, that does not mean we're not going to see a slowdown. And again, as he pointed out too, as you look around the world, there's just a lot of challenges in the marketplace. Yeah.
We talked a little bit about the deficit. We didn't get into it as much as I thought we might, but I think to summarize, it's extremely important for viewers that the big problem with the deficit is we've normalized spending at emergency levels. I just can't stress that enough. If you go back to even the Trump years pre-COVID, we were in 3-digit, hundreds of billions. And now we're 2 trillion pretty much for the next 10 years, according to the CBO. I think everybody's just sort of given up, in the CBO office, and they're not afraid, to say that we're going to have $2 trillion deficits for the next 10 years. But do you agree with that concept that we've normalized spending at emergency levels?
Absolutely. We've seen the same thing in Canada, as you've seen, again, in the United States. I like that expression. He said fiscal policy is making a mockery out of the New Deal. And the spending because of COVID and the sort of the legitimatization of just fiscal spending that's out of control was crazy. And so the deficits were just massive, but they really haven't trimmed the spending. No. And so, as I think David pointed out, the spending is still 50% ahead of what it was in 2019 before the crisis. And that is just not sustainable. I think, look, I've been a Donald Trump supporter in terms of a lot of his economic policies. I appreciate those policies. Doesn't mean I agree with everything, but the overall, smaller government, less regulation, lower taxes, and so forth. But having said all of that, they continue to spend and spend and spend and spend. And that's why I think you want to own gold and some of the precious metals. And I think that's why, we're seeing the precious metals do well. And of course, David talked about that also, that, the spending just seems to almost be impossible to curb. The governments around the world are just continuing to spend like drunken sailors. And the global debt to GDP, as we know, is well over 350% debt to GDP when you look at the total global debt.
Mm-hmm.
And 20 years ago, that was about 225%. So again, these are not sustainable trends. And that's why I think investors need to be careful and use what's happening to position yourself in businesses and in areas that are going to be more defensive, and also probably hedge some of your risk.
And I'm sure you were just as surprised as I when David, who I wouldn't expect to be really specific about a gold target, let us know that $6,000 is in play if this bull market plays out as past have. So I was a little surprised by that. That's a big number.
Yeah, it is. But when you consider the financial stress, the monetary pressures, and so forth of these massive debts and deficits, that's basically less than a double from where it is now, and so it is doable. I know it sounds crazy,
Mm-hmm.
and of course, he's not saying you'll necessarily go get there, but it's certainly possible.
Mm-hmm.
As you know, also, if you listen to James Rickards and other, very highly qualified people, when they just do back of the envelope calculations, if you were ever to try to collateralize some of the currency, not all of it, 25, 30, 40%, I mean, you're talking gold prices that would be, north of $20,000. So the point is, can you maintain the credibility of these fiat currencies, not just the US dollar, but fiat currencies in general around the world, given the massive amount of debt that's behind them? And that's, I think, a question for investors, that they need to at least have some of that risk hedged if they're wise. And he pointed out gold. He also pointed out gold miners. Again, you need to be careful when you're buying gold miners. You have to really know what you're doing because it's a tough business. But he's quite right. A lot of the mining businesses are not trading at very high valuations.
Mm-hmm.
And so people talk a lot about AI, and they talk about data centers and robotics and all of the digitization, which is driving an energy revolution. And yet a lot of the commodity stocks that underpin all of those technologies are actually not trading at very high valuations. So you can buy some of them at maybe 10 to 20% of the valuations of some of the tech companies. So I think there's some opportunities there.
So, and along those lines, for Wealthion viewers who might be interested in gaining some of your firm's input and a portfolio review and that type of thing, how can viewers contact you to get the benefit of your advice in reviewing their situation?
Sure. And we have quite a few Wealthion clients now. People have come through Wealthion. We really appreciate it. We love working with them. Tremendous clients. They're usually very knowledgeable of what's going on. So we like clients like that we can sit down and talk with. So the best way to contact us is info@rocklinc.com. Just email us. And that's Rocklinc, Rocklinc. So link with a C at the end.com. Or they can go on our website, www.rocklinc.com, and just go to the contact section. That's probably the best, and just reach out to us. I can give phone numbers too, but just right through the email. And we will respond right away. Free analysis of your portfolio, sit down, talk with you, and get to know you better.
Terrific. Jonathan, thanks as always. We'll speak to you soon.
Great. Thank you so much, Trey.
Take care. If you have questions about the current market environment and are looking for guidance on your portfolio, Wealthion can help connect you with a vetted advisor to get a free portfolio review. Just click on the link in the description below or head to wealthion.com/free.